Hi everyone, I'm David Scranton, and of course, you know the old saying, what goes up must come down, and of course, it's true in the physical world. But the question is the opposite true? Today, we're to be answering that question right here on the show, and specifically, we'll be discussing interest rates, a topic central to investing for income. You guessed it, it's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. When investing in the universe of bonds and bond-like instruments, interest rates are one of the key factors in many ways. However, there are a lot of misconceptions about interest rates and how they affect income investing. So we're going to give you the scoop right here on today's show. Specifically, we're going to be talking about how interest rates affect income-generating investments, as well as how those same investments can have reduced downside risk regardless of which direction interest rates are going, and how income specialists use interest rates strategically to your advantage, and finally, why investing for income is a sound strategy even when rates are rising. Income specialist and best-selling author Jeff Small, of course, joins us again this week, but we'll also be talking to Greg Daco, the U.S. Chief Economist at Oxford Economics. But first, let's talk about the most important role that interest rates play in an income strategy. And of course, that role is generating income for you. I'm sure that one of the earliest financial lessons you learned is how interest rates help your money work for you, as the expression goes. As a kid, your parents probably explained that when you put money in the bank and just leave it there, it grows, it earns interest. And it was a pretty exciting concept. Now, in the 1960s and 1970s, the average personal savings rate ranged somewhere between 7.5% to 8.5%. Interest rate accumulation on your lawn mowing money back then might have helped you buy your first car. All you had to do was keep it in the bank. Of course, that's often easier said than done. Because another one of the earliest lessons you probably learned about money is that when you have access to it, it's known as liquidity. And when you have liquidity, you're more likely to spend it. And that second lesson still holds true for a lot of people. While the first lesson is still technically true, this concept is a lot less exciting than it used to be where banks are concerned. Let's face it, banks and money market interest rates have been under 2% now for over a decade. And today, they're under 1%. So that means that if you have money sitting in a savings account or even in a bank CD, it's not really working for you. It's not growing. Instead, it's actually shrinking when you factor in average annual inflation rates of 2 to 3%. So there's really not much difference between putting your money in the bank and sticking it under the mattress. Now, of course, it can be safer in the bank because if your house starts on fire, it doesn't burn. But the bank is not helping your money work for you. And when you're in or nearing retirement, the rules change. You need your money to work for you. And specifically, you need it to generate income. Because you're not saving up for your first car anymore. Instead, you're counting on a steady stream of income to meet your needs and to achieve your retirement goals. Here's the good news. When you invest in this universe of bonds and bond-like instruments that make up a typical income-generating portfolio, you're earning income at an interest rate that's much higher than any bank can offer, typically somewhere in the range of 3 to maybe 5%. And that's only one big benefit of investing for income where interest rates are concerned. So before I talk more with Jeff Small, let me take a minute to answer one of your questions on today's topic. Today's Ask Dave, Kelly from Michigan says, Dave, what's the basic difference between short-term and long-term interest rates? Well, the answer is a little complicated, but the simple answer, Kelly, is that short-term interest rates are actually set by the Federal Reserve. And right now, they're set at somewhere between 0 and 0.25%. Long-term interest rates aren't set by the Federal Reserve. They're really set by various market forces. So as a result, the Federal Reserve has a little bit of control over them, maybe can manipulate them, but ultimately they're driven by optimism or pessimism, or perhaps thoughts of future inflation or lack thereof in the financial markets. Now, be sure to submit your own questions to Ask Dave by emailing me at askdave@theretirementincomeStore.com. Now it's time to bring in my good friend Jeff Small, who I understand has a few curveballs for me today in the form of more Ask Dave questions that might be a little more sophisticated. He is president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff is also best-selling author of the book, Turning Financial Planning Right Side Up. Jeff, thanks so much for being back with us here. Of course, it's always great to see you here on the show.
Absolutely, Dave. I love being here with you, but I'll tell you, these Ask Dave questions are a little soft. I think I'm going to kick it up a notch and see what we can really get out of you.
Okay, let's have at it. Let's have some fun today.
Absolutely. Absolutely. So, on that note, in your infinite wisdom, Mr. Scranton, tell us what you think people misunderstand about interest rates and how they really work.
Well, I think the biggest thing is what I just mentioned to Kelly, the fact that short-term rates are set by the Federal Reserve and long-term rates are market-driven. So when people hear about all this quantitative easing and all the stimulus the Federal Reserve is doing, essentially printing of money to buy back bonds, the goal of it is to drive down long-term interest rates. And again, I think most people don't understand that.
Well, I always thought the goal of it, Dave, really was to create confidence in consumer land so people would borrow more and spend more, because the confidence factor is really what most resonates with consumers, besides all of the technical stuff that you mentioned. But to expand on that, how can you explain how the seller of a bond or an annuity is able to guarantee a fixed rate?
Well,
how do they do
part
that?
of the reason they guarantee a fixed rate, any borrower can guarantee a fixed rate, but part of how they do it, quite frankly, and how they can do a higher rate than what's available in the bank is because they bypass the middleman. All those branch offices that you see on virtually every corner of America, those cost money. So by taking the bank out of the middle between the saver and the borrower, essentially that means that corporations, when issuing bonds, can pay more interest to the bondholder.
Great answer, Dave. Great answer. So we're going to change this segment to not Ask Dave, but Grill Dave. However, besides corporate bonds, municipal bonds, and annuities, what are some of the other types of investment tools that we utilize on a regular basis to generate income on a fixed rate for a fixed rate of interest?
Some of the other things are in that part of the universe of bonds and bond-like instruments. So you start to get into things like preferred stock, BDCs, business development companies, to some extent REITs, real estate investment trusts, which are essentially a hybrid between a stock and a bond. Those are just some of the things that are applicable here. And frankly, those are things that we're going to be talking more about, Jeff, coming up right after the commercial break in just a moment. So right after the break, we'll be back here with a lot more from Jeff and Dave and economist Greg Daco coming up on the income generation. We'll be right back. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free Retirement Income Kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749, online at theretirementincomeStore.com.
Welcome back to The Income Generation. I'm David Scranton. Of course, I'm here with my good friend Jeff Small, and in a moment be bringing in famed economist Gregory Daco. But so far, we've discussed how interest rates, as you're aware, are the key to generating income at a fixed, competitive rate once you retire. But the question becomes, how do changes in interest rates affect the value of your principal? Well, as you know, corporate earnings and interest rates go up and down all the time. And as a result, stock values, bond values, and financial markets in general are always in flux. And that's what makes the idea of putting your money to work for you simple in theory, but not easy to execute. And this can apply to income-based investing as well. You see, with an income strategy, rising interest rates create what we often refer to as a headwind for your investments, while falling interest rates can actually create a tailwind. And of course, that's based on the well-known rule that when interest rates rise, bond prices tend to fall, and vice versa. But like most things in finance, it's not that clear-cut. Remember, when you invest in bonds and bond-like instruments, you are investing by contract. And that contract typically guarantees two things, one of which we already mentioned, and that's income being paid to you at a fixed dollar amount for the life of the bond. Of course, that assumes no defaults or bankruptcies. So that means that if your contract says you'll get income at, let's say, 3.5%, that means you'll get it at that 3.5% payment no matter what, regardless of whether interest rates go up or down. But what happens to the actual value of your bond? Well, that's where the headwind part comes in. Because rising interest rates will cause the value of individual bonds and bond-like instruments, as a general rule, to drop in value. And you'll see that loss reflected in your monthly statements. And by the same token, when interest rates fall, you're likely to see your values increase. Now, these changes might affect your mood and how you feel about things, but they don't affect how your money is working for you. Why? Because of your contract. So your bond value might fluctuate on paper due to this interest rate headwind or tailwind, but it has a par value or a face value that can't fluctuate and doesn't change. And this is the second guarantee. And it's how you know you'll get your full investment back when the bond matures, again, assuming no defaults or bankruptcies. Now, by contrast, think about common stocks, which essentially have no par value and certainly have no contract, which means that with a common stock, any loss in value becomes a real loss, not just a paper loss. Now it's time to get to another one of your questions in our Ask Dave. Jim from Virginia says, Dave, I understand my contract protects me from a loss in value with an individual bond. However, if my bond has increased in value by the time it matures, do I benefit from that? Do I get more back than just the par value? Well, that's a great question. And the answer is, if you hold it to maturity, no, you're only going to get the par value back. However, what some people might do, and this is where investing in bonds and bond-like instruments is simple but not easy, is that if they do find that they have a tailwind and the value does go up on paper, they may decide to sell that bond early and realize a profit. So great question, and thanks so much for contributing. I really appreciate it. And hey, keep your chin up. You know why? Because it's spring and the weather in Virginia is about to get a lot better. And for the rest of you, please be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. So now let's bring back in my good friend Jeff Small to continue the grilling process, the Dave Scranton grilling process. Jeff, this shouldn't be called Ask Dave. This should be called Stump Dave, should it not?
Stump Dave. It's really hard to stump you though, but I think I can do it. I think I'm up to the task.
All right, let's go. Let's have at it. Let's see what you have for me.
All right, sounds great. So, Dave, I'm a market historian. I study the numbers. I know what types of lost opportunity, their costs there are. But when a stock market has a loss, it's not only a real loss, it can be a much bigger loss. Tell us how you feel about that.
Well, even if a company defaults on a bond or a bond-like instrument, there's potential to get some money back when they go through the bankruptcy proceedings. But when a company goes bankrupt and you own a stock, you're by definition going to get zero back. Nothing, nada, zilch. So that's why, when people say, gosh, bonds are risky when interest rates are going up, they lose sight of the fact that interest rates going up creates a bit of a headwind for stocks too. And stocks are almost always riskier than bonds.
Well, that's true, Dave. And we have both seen many, many real world examples of that type of scenario.
Yeah, we just saw one a year ago, right, Jeff? We saw almost a 40% drop in the markets with COVID-19. But, this generation, this income generation, if you will, they've seen it too. We've all seen it. We've seen it when the tech bubble burst in 2000, then when the market barely got back to its previous peak in 2007, just momentarily, and then the financial crisis hit and it dropped again in 2008. All told, the market was underwater for a good part of 13 years, the first 13 years of this century.
Well, those are all very valid issues and points, Dave. But when you factor all of that data in, that market history of peaks and valleys, it doesn't always necessarily mean the stock market can't be part of an income-based strategy. Because if you have an income-based strategy and a portion of it is in common stocks, tell us how you think that works, Dave.
Well, bottom line is, as you know, Jeff, when you have a stock market-based strategy, the key is to be in high dividend stocks. And because you're talking about what's called value stocks versus growth stocks, sometimes picking those stocks can be trickier. So that's really, truly an example of where something is simple, sounds simple, but it's really not very easy to execute.
So far I haven't been able to stump you, but this one might. So basically, Dave, for someone with a portfolio made up of only bonds, let's say, and bond-like instruments, what else besides interest rates could affect their investments?
Well, the biggest thing is this thing called credit spreads, which we're going to be talking about in just a minute after the commercial break. But it's basically the difference in how interest rates change with risk-free bonds, like U.S. government bonds, versus how interest rates change with bonds that have a little more risk in, whether they're municipals or corporates. But again, that's something we're going to be talking about coming up in just a bit. And right now it's time to bring in our first guest, a repeat friend of the income generation, Gregory Daco. He's the U.S. chief economist at Oxford Economics, and he's responsible for producing the U.S. economic outlook using their proprietary global economic model. Greg, thanks so much for being back with Jeff and myself here on the Income Generation.
Greg, it's great to see you. Hey, listen, right out of the gate, I want to hit you with the Fed's new business model, which is inflation. Devaluing currency, create as much inflation, as much consumer demand as possible. What's the story? When does this peak, or when do we have to worry about this asset bubble exploding?
Well, I think what the Fed is intending on doing is essentially sustaining as strong of a recovery as possible. So essentially ensuring that it does not tighten preemptively in terms of ensuring that recovery that is strong and sustainable. And it wants to, as a reminder, generate as broad and inclusive employment gains as possible. So it's not going to react preemptively to higher inflation, and will want to remain with policy as accommodative as possible.
So consumer demand is off the charts, though, in this low rate environment. Do you think that is going to continue?
I think so. I think we are likely to see a real boom in terms of consumer spending activity in 2021. It's going to be supported by three factors. Number one, a better health environment with increasing vaccinations across the US. Number two, an environment in which the weather is going to be improving, and therefore service sector activities are going to be rebounding. Number three, of course, a big fiscal impulse from the American Rescue Plan.
And so what kind of expansion in GDP are we going to see year over year? I mean, they're talking about the greatest expansion post-World War II. That's a big number. What do you think we're going to see?
I think we're going to see growth around 7% this year. We have growth at the end of this year around 7.2%. That would be the strongest performance for the U.S. economy since the early 1980s, 1984 to be precise. We're also likely to see 7 million jobs being added to the U.S. economy, an unemployment rate with a 4% handle by the end of the year, and a little bit higher inflation. And that's going to be something that the Fed's going to want to monitor very carefully. Greg,
that's amazing. 7% is going to put the economy far ahead at the end of this year compared to where it was at the beginning of last year. But Greg, don't go away. We're going to continue our conversation later in the show. And coming up after the break, we'll talk about other ways that the income-based investing model can help you play good financial defense. Stay with us. We'll be right back on the Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to the Income Generation. I'm David Scranton. I'm here with Jeff Small. And in a moment, we'll be bringing in Greg Daco, famed economist, as we continue to unravel the mystery of interest rates. But so far, we've seen how investing for income can lock in the dollar amount of your income at a fixed dollar amount, and also helps protect you from a real loss when interest rates rise. But there are other ways the income model helps you play good financial defense. As we discussed, most people know about this inverse relationship between bonds and interest rates. When one goes up, the other goes down, and vice versa. In fact, we saw this happen in early 2021, just over the last 3 months. The yield on the 10-year government bond rose from 0.8 to over 1.6 between early January and now. Essentially, it doubled. So what does it mean if you held a 10-year Treasury bond? Well, if you do the math, it meant that the value of your bond would have been down by about 7% in the first quarter of the year. But that's not what most income investors saw. In fact, if you were an income investor with a diversified portfolio of individual bonds, you might have seen your portfolio down only 2 or 3%, or possibly not at all. And that's due to something known as credit spread compression. See, the fact is that when interest rates rise and they cause bond values to fall, you have to ask which interest rate. And the interest rate that applies to your investments has to be the specific interest rate that corresponds to that particular class of bonds. So yes, if you have a risk-free U.S. Treasury bond, it tracks the U.S. government bond rate. But let's say you had a BBB corporate bond. Then the interest rate that affects your bond is the one commensurate with BBB corporates, not the U.S. Treasury rate. And here's why that matters. You see, when interest rates drop, it's typically because investors are worried about the economy, right? Because long-term rates are driven by markets. And when rates rise, it's usually because investors are becoming more confident about the economy. And when you're worried, the amount of extra interest that you might require to go from a risk-free Treasury to a corporate bond, let's say, is likely to be much higher. That extra instrumental interest will be much higher than if you're confident. Therefore, the interest rate on that corporate bond won't decrease as much. And when the opposite happens, when interest rates rise due to investor confidence, these things called credit spreads, this extra interest demanded by going from government to corporate bonds, actually compresses. And this acts as something I like to refer to as a natural softener for income investors. Why? Because the rate on your corporate bond doesn't increase as much as it does on treasuries. In other words, credit spread compression softens the impact of rising rates on a diversified portfolio of bonds. So now let's get to another one of your Ask Dave questions. Susan from Ohio asks, is it a problem for income investors if interest rates continue rising, and do you think that would happen? Well, Susan, if we end up with interest rates that continue rising, get up to where they were in the late 1970s, yeah, it's going to affect all income-based investors across the board. But for reasons beyond today's show, I do not see that happening in any way, shape, or form, not just because of demographic trends, but also because the government now has basically set a precedent. The Federal Reserve has set a precedent in keeping those interest rates as low as they possibly can. And frankly, the higher the government debt gets, the more the Federal Reserve has to help out and keep the cost of interest on our own government bonds as low as they possibly can. So Susan, thank you for your question. And for everybody else, please be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. Now, let's bring in Jeff for more of the Dave Scranton grilling. Here we go. What do you have for me now, Jeff?
I got a really good one for you, Dave. So if you're like me, you probably use this explanation of risk premium and credit spreads as a way to show how bond values aren't strictly tied to interest rates. Why is that?
Yeah, I do. And the tough part is I can only do that for sophisticated investors when we talk about this concept of credit spreads. I even thought about us not even putting what I just said in the show because it's very complicated. And a lot of people don't understand it. They don't want to understand it. But for those that are a little bit more sophisticated that maybe think they can just do it themselves, when they realize this particular credit spread component, then oftentimes they realize they might actually need some professional expertise.
Yeah, credit spreads can be tricky for the average consumer, Dave, but I use it to show how diversification is important in any investment strategy, including an income strategy.
Oh, absolutely. Because there's times when higher quality bonds that are higher rated, that have a smaller credit spread, are helpful in the portfolio, and times when those are a little bit lower rated with lower quality, lower ratings, let's say, and a higher credit spread are helpful in the portfolio. So by diversifying and balancing the two, it definitely helps lower volatility on their principal values every month when they get their statements.
You know, Dave, and occasionally I see an investor or two who's a do-it-yourselfer that gets it right. But it's just a matter of doing a little research about bond ratings and creating their own portfolio, even though the average investor should leave it to the professionals, correct?
Well, yes, because it's not just about bond ratings, as you know, Jeff. It's also about looking beyond the bond ratings, digging through the financials of the company, right? Then it's also about the price at which you can get a bond. If you just go through your broker, through your clearinghouse and buy a bond, most likely you're overpaying because of the spreads that are built in. And I don't mean credit spreads. This is a different spread. But last but not least, please listen to me on this. Don't use bond mutual funds. If you have anywhere over $100,000, $200,000, individual bonds and bond-like instruments are almost always, if you're diversified, a more conservative strategy than bond mutual funds.
So, you know, Dave, there are lots of benefits to having an income portfolio that's not only well diversified, but actively managed, correct?
Absolutely. And we're going to have Greg Daco back, but right after that, in the next segment, we are going to talk about this just a little bit. And we're going to talk about how active management can help you play offense, potentially, even when interest rates are rising. Now it's time to bring back Greg Daco, U.S. Chief Economist at Oxford Economics. And Jeff, you seem to be on a roll, so take it away, my friend.
So, Greg, you know, I kind of think like we've seen this show before financially in terms of all the fiscal and monetary stimulus. And this stuff is just record-breaking, the amount of money we're spending and the deficits over $3 trillion a year in terms of what we're doing. But the reality is at some point that stimulus has to stop. It can't go on forever. So give us what the window looks like on that.
Well, I think when we look at the fiscal impulse for the U.S. economy, and we look back at the last 3 months, we've had essentially $900 billion of COVID relief from the package that was passed at the end of December, plus $1.9 trillion from the American Rescue Plan. That should combine for a fiscal impulse of about 4.3 percentage points this year, but that's going to fade away. Less fiscal aid will be available going into 2022, unless, of course, there is the Build Back Better investment plan that Biden has been talking about, which could be another $2 trillion over the next 10 years.
That's crazy. So basically, I think you're talking about the stimulus package or the infrastructure package of around $2 trillion that they want to build, correct?
That's correct. The Build Back Better plan is essentially geared towards increased infrastructure spending, research and development activities, tax incentives for green energy. All those investments would total about $2 trillion. Now that's over 10 years. So that's important because that would lift the potential supply of the US economy. And that would actually be a long-term gain for the US economy, which would be less similar to a one-time shot in terms of fiscal impulse.
But the stimulus side of the equation is, at that point, maybe they start to taper off and demand starts to stop. So when does this pop? When does the stimulus bubble pop? And when do we start to destimulate the economy, so to speak?
Well, I think in terms of short-term stimulus, we're going to see much less of that towards the back end of this year. Even some of the stimulus and the aid that is being doled out right now is based on the number of people that are unemployed. And hopefully, over the course of this year, we'll add about 7 million jobs. So there will be fewer unemployed individuals, and therefore less aid will need to be provided to the people that unfortunately have lost their job. So less fiscal stimulus towards the back end of the year. But again, this prospect for more supply side growth with greater investment spending as part of the Build Back Better plan.
Greg, we have to take a commercial break, but I can't wait when we come back later in the show to have you talk about inflation and what we think the impacts on inflation are going to be with all this spending. So stay with us, because coming after the break, we're going to talk more about how you could make money in an income-based strategy, whether you have an interest rate tailwind or an interest rate headwind. I'm David Scranton, and you're watching or listening to The Income Generation. We'll be right back. I'm David Scranton. When it came time for my mom to retire, one simple mistake forced her to work years longer than she should have. And that's why I started the Retirement Income Store, to help hardworking Americans 55 and over plan for the retirement they deserve. I couldn't help my mom, but maybe I can help you.
If you're 55 or older, please claim our free Retirement Income Kit. Chock full of information you need to know to get steady income during your retirement. Call 866-314-7227. Online at theretirementincomestore.com.
Welcome back to The Income Generation. I'm David Scranton. I'm here with Jeff Small. And in a moment, we're now Greg Daco back to talk more about interest rates. And so far, we've talked about how income strategies help to generate income at a fixed dollar amount, and how income strategies help protect your money potentially from interest rate headwinds. But how about a consistent headwind? Earlier I fielded an Ask Dave question about this possibility, the possibility that interest rates will continue to rise. And as I explained, I believe that we'll be in an overall low interest rate environment for quite a long time. And with that said, it's also important to understand that the trend of overall declining interest rates is probably over. For about 40 years now, starting around 1980, bond investors mostly had a tailwind. You could simply buy a bond, hold on to it, knowing that its value is more likely to go up than down. But I knew that this long-term trend of declining rates would eventually bottom out. And of course, this would make things more challenging for income investors. I also knew that active management is the key to meeting that challenge in a rising interest rate market. So as I said earlier, financial market indicators are always in flux, and that includes interest rates. And what's more, they constantly experience minor ups and downs within the broader directional changes. You see in the stock market all the time, right? Big, dramatic intraday point swings. And if you're a buy and hold stock investor, those swings don't mean much in the big picture. But if you're a day trader, they can be very meaningful. And the similar thing is true when you're talking about actively managed portfolios of individual bonds and bond-like instruments. But it could be an advantage for an income specialist who actively manages, continually manages these bonds and bond-like instruments, because that allows that person to take advantage of minor fluctuations in the bond market. How? Simple, to upgrade your portfolio for higher yields and possibly for capital gain opportunities. So that means that essentially active management not only allows you to help protect your portfolio from potential losses in a rising interest rate environment, but also gives you some potential upside to increase your future income. And even better, any loss you incur from an interest rate headwind is typically only that temporary paper loss. Again, because you have a contract that guarantees your principal be returned when the bond matures, regardless of any interest rate headwind. And as I've said before, of course that assumes no defaults or bankruptcies. Meanwhile, it's generating income at that fixed dollar amount, income that you can use to meet your income needs, or if you don't need it, to reinvest your money strategically to grow your portfolio, as I like to call it, the old-fashioned way. Now let's take one more question from you. Brian from Florida, you ask, Dave, I've been hearing talk for years about the possibility of negative rates. What would that mean for income investors? Well, Brian, as you might know, if you're a regular viewer, regular listener, I'm actually a flight instructor, and one of my flight students from years past is somebody who owns a small regional airline over in Europe. And he said to me just recently, he said, it's really great because I could borrow money at 1.5% to buy a used Boeing 737, but when I put my money in the bank, I'm losing money. I actually have to pay them to hold it. So that's what we'd be up against should that happen. But the good news is now that you know about credit spreads, Brian, that doesn't necessarily mean that corporate bonds and preferreds and these other things will be in a negative interest rate environment. In fact, it most likely means that you'll still be able to get some interest or dividends from those types of things. So again, Brian, thanks for the question. I love it. And be sure to send me your questions by emailing me at askdave@theretirementincomeStore.com. And now it's time to bring back in Jeff Small, who's had a little bit of a rest. Jeff, you look like you've had not only a little rest, maybe you got to walk around, maybe you had a sip of water. You're ready to have at it again. Let's go.
I'm just laughing at the brain dump you're doing today. It's pretty impressive, Dave, but let's get back to it. So when we look at things like active management and passive management, why is active management important for an income specialist in recent years? Why is that an issue, Dave?
Well, in recent years, from 2016 to 2018, we saw longer-term interest rates start to go up again. Heck, we saw the 10-year government bond get up to 3.25% for a short period. That was back down to 0.8 at the beginning of this year. So it's really the first time in a while that active management has almost been necessary to fight an interest rate headwind. And I think we're going to see more and more of that in the next few years.
Yeah, we're definitely living in a weird interest rate time as rates move up organically. It's really important for a portfolio manager, though, to specifically try to maximize someone's income return in this environment while balance that out, correct?
Yeah, it's funny because I'll give you one example of a trade that, as you know, we're making right now. Some people think that you buy the bond and you hold it and that's it. But sometimes we have this thing called rolling down the yield curve. As bonds get closer to maturity, not too close, they're still selling at a nice premium. And essentially that means if you hold it to maturity, you're really earning very little because remember, it matures at par value. So when they start rolling down the yield curve, it's oftentimes a good strategy to sell some of those, take the profits, stretch out the term a little bit, and get a higher yield. And that's one of the ways that we can help people combat that interest rate headwind.
Very true, Dave. So when we look at the returns, though, on fixed income, there can be challenging because really what we're looking at is a 3 to 5% rate of interest. And so some consumers might feel like, or income generation members might say, well, I'd rather be in the stock market because I can get 8 to 10% there, but it's not quite that simple, is it?
Well, as you know from talking to your clients, whenever you say, how much interest or dividends did you earn last year? And they'll say, well, 11%. And they're quoting total return. So when you hear that 8-10%, as you know, it's total return. In fact, if you're invested in the S&P 500 index, the Fortune 500 companies, your dividend yield right now is just a hair over 1.5%. So we're talking about the 3 to 5. As you know, Jeff, we're just talking about the income component. And with any luck, crossing our fingers, we can engineer some gains through some of those swaps that we talked about earlier.
Dave, you're exactly right. So far, you've passed every question I've asked you. But more importantly, the returns have to come in the form of income in the future. And your strategy, Dave, and my strategy helps protect you from a major loss, which should be top priorities for people in and nearing retirement today.
Yeah, well, absolutely. As Greg Daco, of course, who we're interviewing today, actually, you're interviewing him. I've had enough time, haven't been able to get a word in edgewise, so that's okay. He's an economist, but even though he's not a financial advisor per se, he knows that as you get older, you want to protect your principal. You want to protect it, whether it's from fluctuations, and also protect it from defaults. So with that, let's bring back in Greg Daco for one final segment here on the income generation.
So Greg, let's talk about one of my favorite topics because we're hearing about it all over the media today, and that is inflation. Things are in hot demand. Prices are going up. Energy prices are spiking. Prices for pressure-treated wood are $6 for a 2x4. It's crazy what's happening. So give us your picture on inflation. Is it real?
Yes, inflation is real. It's actually unavoidable. An environment where you see stronger demand, in particular stronger demand for goods, you're going to see firmer inflation, and we're already seeing that. The key question is whether it's controllable, and I think it is controllable. We will see higher inflation going into the next few months with some favorable base effects relative to last year, with some push up from energy prices, and with fiscal stimulus stimulating demand. I don't think, though, we will get spiraling inflation, which would be a key concern for the Fed and for the broader economy.
So what happens to inflation, though, Greg, when consumer demand starts to wane, taper off, or contract?
Well, that's actually an endogenous brake on inflation. When you see prices rising too fast, then it tends to weigh down on demand. If inflation then it contracts or slows, that is actually a good thing for the economy. The key risk is that inflation expectations become unanchored, and that would be a phenomenon by which people expect inflation to keep accelerating and therefore pull forward their demand because they're worried about hyperinflation. That's not going to happen in the US. I think we still have a lot of factors that will keep inflation under control, but inflation will certainly be a lot warmer than it's been over the past decade.
In 40 seconds, tell us what your factor is on interest rates going forward over the next 24 to 36 months. Will we see a non-organic move in rates?
Well, I think we will continue to see the reflection of stronger growth, that reflationary trade with long-term yields rising over the next couple of months. But I think the Fed will maintain a strong anchor in terms of short-term rates, and we're likely to see short-term rates remain at the effective zero lower bound for the next couple of years.
Greg, thanks so much for being back with us. It's awesome. Jeff, great interview. Thanks so much. I love you, bud. And that's it for today's show, everybody. I hope you learned a lot about investing for income and how interest rates affect investing for income and what strategy you should be taking. Bottom line is if you're approaching retirement or you're retired and you're concerned in any way, shape, or form, it's important you stay informed and up to date. And as you know, right here is where you could do it on the Income Generation. I'm David Scranton, and we look forward to seeing you next week.